Okay. Hi, this is Manikarthik here. I hope you can hear me. So we're starting right on time. We're just going to give maybe just 1 or 2 minutes for the rest of the folks to just join and log in. We have a wonderful session ahead. We have about 52 people joined so far, and there's a long queue, I'm sure. I hope all of you can hear me properly, the audio. Great, wonderful. Okay. So let's get started because we have a long session ahead and we're hoping to have some Q&A sessions also squeezed in towards the end. And usually those get out of hand. So I'm just trying to not waste any more time. Great. So good evening, everyone, and welcome to today's live webinar. My name is Mani Karthik, and I'm the founder of the Back to India community. We are about 25,000 folks strong, and it's probably the largest growing NRI community on the internet today. It's been close to 7-8 years of existence, and our objective is to help NRIs plan and execute their move back to India and make it worry-free and as easy as possible. And the way we do that is by helping share the information that we know, whatever that helps for an NRI to plan moving back to India, about finance, logistics, education, family, pretty much everything. You can join us on backtoindia.com. So today we have a special session, and this is designed specially for the Back to India community members and NRIs who are planning returning to India in the next few months. If you're at that stage where questions around money start getting louder, then this webinar is for you, because today it's all about clarity. Because when it comes to personal finance, there's a lot of information out there. You don't know what to trust, and it always helps if there is an expert to help answer your questions. So we're not dealing with any theory or jargon today, but the real financial decisions that actually matter when you live across geographies, across continents. And we'll be covering the essentials every NRI should understand: how to plan your return to India sensibly, what to watch out for in terms of taxation and repatriation, and how to think about investment opportunities in India once you're back, and how to start planning it while you are in the US, UK, or anywhere else in the world. And to guide us through this, we have two experts who work on these exact problems every single day with us today. First, we have Ritika Arora. She's the Associate Vice President at Scripbox. Ritika has over 15 years of experience as a wealth manager. She's a NISM certified NRI wealth expert and is based out of Delhi, working closely with NRI clients on investment and long-term planning. And joining with her is Ravi Chowdhury. He's a cross-border tax expert with more than 10 years of experience. And Ravi is based out of Bangalore and specializes in taxation and compliance issues that NRIs often struggle to get straight answers on. I'll be facilitating today's session. I also have Prashant with me from the Scriptbox team here. So let's keep things moving and making, just to make sure that we are staying focused and what is most useful for all of us. Feel free to drop your questions throughout the session in the chat box here. I'll try to curate them and attend them towards the end of the session, but make sure that you put it out as descriptive as possible and not vague. Oftentimes what happens is we have the same questions over the same themes and questions repeated, which is not the best use of our time. So if you can make it as descriptive as possible, me and the Scriptbox team will curate and pick and choose the best ones and address them towards the end of the session. So with that, let's get started. I will share it over to Ritika. Ritika, welcome on board, and feel free to get started with the session.
Thank you. Thank you so much making us a part of this wonderful community. I hope all of you find this session useful. I will try and quickly finish what I have to say so that we can jump on to the meatier part of this whole session, which is the Q&A round. And let's start. Thank you for that wonderful introduction. So what are we going to cover today? I'll straight away jump into what we are going to cover today in the next 40 minutes that I need. First, the absolute essentials, the absolute basics. Second, returning to India, the checklist that we need to kind of see the decision that we need to make while we are making a plan to return to India. The most overwhelming part comes in next, which is the whole residence, tax residency, and the transition from becoming NRI back to a resident. Fourth, we'll cover investment opportunities that are in India, available in India. We help as Scripbox. Then we'll open the floor for questions. Me and Ravi together will try and attend to as many questions as possible. Financial best practices is my first slide, which is applicable to everybody, whether in any life stage, in any jurisdiction. This is the absolute basic, but I still wanted to quickly cover these. As my mentor says, failing to plan is planning to fail. We need to maintain goals. We need to have specific goals and align our portfolio, align our investments to those goals. So there's minimum disruption as we go ahead. Protection is extremely important for any portfolio, whether it's health insurance or life insurance. It ensures, again, minimum disruption to the goals, to our financial plan. Asset allocation, again, extremely important, deserves more attention for the right reasons. Towards the end of the presentation, I will discuss one slide which will talk about why multi-asset allocation is extremely important. It smoothens out the journey for all the wealth portfolios. Tax optimization, money saved is money earned. Hence, it's extremely important that we optimize our portfolio for the taxation bit. Succession planning, extremely important for everybody. You work hard all your life. You have to ensure that there are no disputes later, there's no inconvenience later for your family. The most important thing, patience. Any investment idea, any financial product that screams extremely adventurous returns in a very short time mean there's a red flag somewhere. Please note that good portfolios compounding happen with patience in place. This slide talks about who is an NRI. Now, all of you are NRIs, but still Ravi insisted that we put this slide here simply because some of you might not know that there are two definitions of NRI. One is given by the Foreign Exchange Management Act and one is given by the Income Tax Act. We'll get into the detail later on, but you should know that there are actually two definitions of a NRI, and you must make sure that you keep yourself updated with any changes in both these definitions in the country. If you are an NRI already, you know that you either have an NRE account or an NRO account. You also have the option of having an FCNR account. NRE is where you send money back to India. You're earning in your country, you're sending the money to India to get invested. You can take both principals and gains back to your country. And that interest or capital gains is not taxed in India. NRO is for your income that you earn in India. It is ideal for managing rent, dividends, any India based earning. Repatriation is subjected to limits, and also the gains from this pool of money is taxable in India. FCNR is a fixed deposit account in a foreign currency, so you don't have to worry about the currency risk. It offers slightly higher interest rates, and both principal and interest are fully repatriable at maturity. This was something very basic that I hoping that all of you know, but we still wanted to go back to the basics ones. If you're returning to India, what are the few things that you're probably wondering about, the decisions that you have to take? We'll quickly cover housing and healthcare briefly, and then we'll deep dive into the last three bits. Housing, you're probably thinking whether to buy or to rent. We recommend, depending on your place of work, the schooling of your kids, if your kids are in that age bracket, etc. You must ideally rent first before committing a huge capital into a house. Once you're comfortable, once you're sure, is when you actually go ahead and invest and make a long-term commitment, a financial commitment in buying a house, if you already don't have one. Healthcare, costs in India are much lesser than healthcare costs in, in the US or the Canada, or in other parts of the world. However, the healthcare costs in India on the rise. They're increasing relative to what it was a few years back, and it continues to increase at a rapid pace. What you need to do, even if there's a 1% chance that you are going to come back, and I'm sure all of you on this webinar today are here because you want to come back at some point in time. Taking an insurance cover in India is extremely important as early as possible for simple reasons. As we grow older, the insurance premiums go higher. There are waiting periods installed in the policy. And also, as we grow older, sometimes we do get some diseases, etc. The insurance companies can actually refuse to give us any healthcare cover. So as soon as possible, this should be also done. Even if you are planning to come 5 years later or 7 years later, this should be done. It's going to not be a very huge cost to undertake. Securing your legacy, again, filing, making nominations, making wills, it just is a risk management tool for families across the globe. Your children are somewhere, your parents are somewhere, you are somewhere. You need to ensure that this thing is watertight. You need to make different wills for different jurisdictions, um, and make sure that one will does not revoke the other in any case. You have to consult a cross border expert for this. Um, we'll come to the taxes bit. As I said earlier, this is the most overwhelming part, how the tax residency status transitions for anybody, what are the compliances we need to comply to, so to avoid any penalties, etc. Finally, the investment. What are the investment opportunities in India? How will you budget for your lifestyle changes, for your move, and how will you realign? Again, as we said, pehle bhi, how will you realign your investments to your financial goals or to your cash flow requirements when you are in India? Succession planning, I will quickly cover this. As I said, securing your legacy is important. One good thing, a key tax advantage that you get in India is there is no inheritance or estate tax. Gifts from NRIs to relatives are tax free in the receiver's hand. Relatives would mean siblings, parents, spouse, etc. Uh, Anybody who's not in this close circle of relatives, वहाँ पे there's a amount of 50,000 over and above which there is a tax. But as long as you are passing on the property to your children, uh, there is no tax as such. In India, no inheritance or no estate tax. But that is why you should actually take care of transferring your assets or estate to your children as per the foreign rules. So, for example, I know that in the US, above a certain threshold, you have to pay an estate tax. And similarly, in Canada, there is something where it's not called the estate tax, it's not called the inheritance tax. However, once a person passes away, you are kind of taxing them. You assume that they are selling their property at that fair market value, and that is when you there's some taxation, which basically the income gets into the taxable bracket. So clearly, you have to plan the foreign country gift tax rules and the India rules accordingly. Um, this is so the key takeaway that we are taking from this particular slide is consult a cross border estate planner, one, and ensure that there are separate wills for Indian assets and there are separate wills for overseas assets. I think these are the two very, very important things that you have to do. Adding nominees to financial assets is a good habit. It will ensure smooth transfer, but eventually the will supersede any nomination in any assets that you have. We move on to the taxation for NRIs now. For the purpose of this presentation, this webinar, we're going to stick to the taxation for returning NRIs, which means how the status, the residency will change. So you're a non-resident right now. Your income earned or received in India is taxable in India. Your global income, for example, somebody is in the US, your US income is taxed as per the US laws. Once you're deciding to come back to India, you first become a resident and a non-ordinary resident, where the same taxability applies. That is, your India income gets taxed in India, your outside income gets taxed as per that particular jurisdiction. After a few years, 2 to 3 typically, you transition on to become a resident and an ordinary resident, where now your global income is taxable in India. So this is first key, and we'll study through a case study how that happens. So typically, what is the rule? From a non-resident to a ROR to a ROR. ROR, when you become a ROR is when all your global income will start to get taxed in India. When you become a RNOR, you also have to declare all your foreign assets in the ITR. RNOR is a transitional temporary status that actually offers significant tax protection during that time. Um, this is a lot of data on the slide right now, a lot of numbers. I'm sure you would have read this many times. Again, we'll revisit it. If an individual will become a resident in India if he stays in the country for greater than 182 days during a financial year, or stay in India for greater than 60 days during a financial year, and stay in India for greater than 365 days in the preceding 4 years. So as long as these two conditions are met, you become a resident. There's another condition, which is if your India income is greater than 15 lakh, then your stay in India can be a minimum of 120 days. Then you don't have to wait for 182 days to lapse or to be in India. Once this is done, when it is established that you are a resident in India, is when you have to further classify yourself as a RNOR or a ROR, which we already discussed. You will first become an RNOR, then move on to becoming a resident and an ordinary resident. How will we define that? Non-resident in India in 9 out of the 10 preceding years, or you would have stayed in India for less than 729 days in the preceding 7 financial years. There are a bunch of calculators. It is actually better to sit with someone, some tax specialist, tell them this is my date of return, so that the entire thing is more simplified for you. And let's take the example of Prashant, who is working in the USA and is returned permanently to India. His Indian income is 25 lakh, and he came back to India on 11th February 2025. Now, what is his status right now? His stay in India in FY 24-25 is only 15 days. So financial year 24-25. In India, financial year is April to March. So in 24-25 financial year, Prashant's stay in India is just 50 days. And his stay in the last 4 financial year is 200 days. He is not satisfying any condition. Hence, he is not a resident. He continues to be a non-resident as per this logic. So his Indian income is taxable. His US source income or investments are not taxable. And foreign asset disclosure is not required. Scheduled foreign asset is not required at this point in time. There's no need to check the next status because he's clearly a non-resident right now. In the next financial year, in the financial year 25-26, remember he came back to India in February 2025. His stay in India in financial year 25-26, he completed 365 days. With that logic, he stayed in India for greater than 182 days in a single financial year. We'll move to the next step, which is to check his RNOR or a ROR status. He's clearly an NRI in 9 out of the last 10 years. Right now, he's an NRI in all 10 years. And his stay in last 7 years is also less than equal to 729 days, which means he will be a RNOR. Still, he will now be a resident and a non-ordinary resident. His Indian income will be taxable as usual. His US source income and investments will not be taxable in India. And at this time, his foreign asset disclosure is required. He needs to file in the ITR, he needs to disclose all his foreign assets. We move on to the next year. Now we are in financial year 26-27. Now, in this financial year, his stay in India is 365 days. We have already established that he's become a RNOR. We will now check if he is moving to become a ROR this year or not. So we can straight away jump to step two. Is he a NRI in the 9 out of last 10 years? Yes, in 9 out of last 10 years. Stay in the last 7 years is still less than equal to 729 days. He's still not crossing the 729 days in the last 7 financial years criteria or eligibility. Hence, he does not become a ROR, resident and ordinary resident. He continues to be a RNOR. So he came back, just for revision, he came back in February 2025. In that year, he was a NRI. The next year, FY 25-26, he became a RNOR. FY 26-27, he continues to be a RNOR. And now in FY 27-28, we'll check if he's meeting any of the eligibility criteria of RNOR. Is he a NRI in 9 out of last 10 years? No, now he is not. And what is his stay amount in the last 7 financial years in terms of number of days he spent? Now he's crossed 729 days. So now he becomes a resident and an ordinary resident. Will his India income get taxed? Yes, it continues to get taxed. Will his US source income and investments taxed? Now, yes, now they will be taxed in India, because at this point, once he becomes a ROR, his global income gets taxable in India. Foreign asset disclosure he needs to do if he's already not done in the RNOR stage. So that is the case study that we thought we will take you through in terms of the transition of how you will transition. It will typically take 2 to 3 years for you to become a resident and an ordinary resident whenever you decide to come back. If you decide to come back during the February March period towards the end of the financial year, typically you can stretch to next 3 financial years. Foreign assets disclosure, extremely important at the RNOR stage. There's a schedule of foreign assets in the ITR form. You will have to disclose all the foreign assets, foreign bank accounts, foreign equity, debt, anything, any and all of your foreign assets. What you see on the screen are some of them. Um, what if you forgot, you were lazy, or you didn't realize, and you forgot to declare something? You declared 99% of your foreign assets and you forgot to declare one thing, and now it's you filed your taxes in, let's say, May 2025 for FY 24-25, and in June you suddenly realize, I forgot to mention one asset or declare one foreign asset. Don't worry, there is a provision. There's a provision of which is called revised return, which means that if you've forgotten to declare something, you still have 9 months from the end of that financial year before you can go back and revise your ITR. So for FY 24-25, you have time till 31st December 25 to be able to edit or revise your return. That is one. What if you were super lazy and you missed even this deadline? You missed the 31st December deadline and you forgot to declare something. Now, this is where the trouble will start. This is where now penalties will kick in, and heavy penalties will kick in. But you still have about 4 financial years to go before you declare everything. However, this time, the next 12 months, so after 31st December 2025, you have about 12 to 18 months. You have till March 2027 to declare any additional income. But this time, you will have to bear extra 25% of your tax liability as a penalty. And if you cross that date also, you can file your returns, where you can update your returns till 31st March 2030 in this example. But this time you will have to pay an additional 50% of your tax liability. So you have enough time to come back, declare your foreign assets, post your first ITR where you're declaring your foreign assets. You still get time of about 12 to 18 months to declare your foreign assets. And if you still forget anything, you will get time, but this time, of course, you will pay penalties. So the idea is for all of you to know and to make sure that you never reach the updated return stage. You should do everything in the revised return and maybe before that also. This is very important to take care of. A lot of questions come on the double taxation avoidance agreement. It's simple. It's simple to understand, which says it's a formal agreement between India and another country to avoid taxing the same income twice. So suppose you are in the US, you send something to India through your NRE account, you invested in a PMS or mutual funds. Somewhere you invested, you're taking that when you're exiting, when you're redeeming, for example, if you invested in a mutual fund, when you take the money back or when you redeem the money, there will be a TDS that will be deducted for you because you're an NRI. But you can actually go back and say, look, I'm not supposed to pay taxes there. So you can get that credit back. So double taxation avoidance agreement makes sure that for no income you are paying the tax twice. कहीं पे भी अगर extra हुआ है in whichever country, that can be claimed back. What you need to do for this is a tax residency certificate is very important. It basically helps you. This is the document that you need to take care of. You need to download. You need to have to be able to take the DTA benefits, presenting it to the source country. So there's just this much that you need to know, that uh, you don't have to worry that your income will get taxed twice uh, at any point in time. We are then going to come to the investment opportunities. I was going very fast because I want to keep a big chunk of the presentation towards the Q&A. So this is the last section that we are going to start. Investment opportunities in India, investment opportunities. I think India itself is a great investment opportunity. Today, we are a $4.5 trillion economy. We are going the Viksit Bharat way. The projections are the goalpost is $30 trillion dollar economy in another 20 years. The not so good thing is our per capita income, which is still way, way, way behind at just $2,700. But historically, the maximum transition in any country, in any geography happens when the capita income increases. So if you are able to increase from $2,700 to a $15,000 over the next 15, 20 years, we actually move from an emerging market to a developed market, hopefully. And that is itself the biggest opportunity. What you see here is the annual GDP growth rate. The last print that came for India was at 8.2% YOY. We are among the few countries in the world which is growing at that rate. For example, USA, the last print that I was reading was at about 2.3% YOY. Canada was at 1.3%. Just for context, rest, of course, we are at a steady pace growing. One of the largest economies also growing at that pace. This is the Nifty 50, which is the leading index of the Indian capital markets, the equity markets. In the local currency terms, right now, this chart does not include the NR-USD relationship. But in local currency terms, in the last 20 years, we have done as well as the NASDAQ in the US and much better than any other market index. Hopefully, we will continue to do that in long term. The rate is about 12 to 13% in that period. What you see now on the screen is again how we have done versus the other leading economies, how our inflation has done, how our equity returns have been, how our debt returns have been, how our gold returns have been. And you will see that India is clearly leading, one of the leaders here, both in terms of equity and debt. But again, please note, this is a 20-year CAGR compounded return. And in local currency terms, this right now does not include the USD INR relationship. In the beginning of the presentation, I had spoken about asset allocation. An asset allocation, a portfolio that has multi assets. If you were to focus on only the India row, you will see that equity, if I were to invest in only equity, I would have made 11.7% over the last 20 years. However, if I had invested in any multi asset portfolio, I would have actually ended up making slightly more or almost equal, while the risk substantially reduced because one portfolio was a 100% equity portfolio with a much higher volatility versus a multi asset portfolio with a much lower volatility. What you see in the last two rows is called the standard deviation, which is basically which tracks the volatility in a particular fund, in a particular stock, in a particular portfolio. You will see domestic equity standard deviation was 21%, and standard deviation for a multi-asset portfolio was 11%, which meant the return profile was plus 21 minus 21 for a 100% equity portfolio and a plus 11 minus 11 for a multi-asset portfolio, clearly showing the importance of asset allocation. So I'm just connecting the two dots, why having your assets, why having different assets in the portfolio is extremely important. Some popular investment choices. We have fixed deposits, we have mutual funds. There is a lot of interest in stock trading, direct stock trading. There's a lot of interest in startup investing these days. Real estate is the darling for many ages. Portfolio management services is relatively new, is still old, but relatively new vis-a-vis all the other asset classes that you see. Government savings schemes have been there for a long time. Gift City is the latest and one of the most efficient, I believe, for the audience today in this webinar. Currently, SBI fixed deposit, a 3-year FD rate is about 6.3% as per the latest rates. You add the taxation, you don't even beat inflation. So any fixed deposit is in that range. Any government scheme is also in the range of 6 to 8.5%, mostly, with taxation in some of them. Mutual funds, what you see here on the screen is an average of a large cap category of mutual funds. So if I were to only invest in the top 100 stocks in the Indian capital markets, if I had invested for the last 3 years, I would have made a 13.7% per annum return. This is the latest as of yesterday after considerable volatility in the last few years. So a category average, large cap, safe relatively, 13.5%.
Niti,
PMS, Hanji,
sorry to cut you there. No, just
sorry.
wanted to jump in there
Ji,
and let
ji.
you take a breather. Good
Oh,
job for the
okay.
30 minutes mark right now. And
Okay.
I've been
Yeah.
getting a lot of commentary positively from the groups saying that it's really valuable. The slides are really descriptive. I just want to also let you know that we
Mm.
have received a large number of questions on the chat.
Okay.
They're all,
Okay.
I'm not sure if each of them can see
Mm.
this. It's
Mm.
pointed as hosts and panelists, um, but we have a bunch of them. So just,
Okay.
I don't know if you want to take a few of them or keep them all for later, just keeping the time frame in mind. You can
Sure. So,
keep a bit small on it,
mm,
but just let me
I
know.
just have, I think I'm left with 3, 4 slides only, and
Sure, go ahead, please.
important ones at the investment choices. So let me finish this and then we'll hop on
Perfect.
to the questions.
Yes, please. Thanks.
Okay. Cool. So investment choices, fixed deposit, mutual funds, a bunch of them. We have figured out first three, these three mutual funds, PMS and Gift City funds, which we like. My favorite is mutual fund, but it's not the most tax efficient and the best choice for the audience here. So I'll tell you quickly what it means. A mutual fund, you all know, there's a professional fund manager, there's an investment mandate, and you get access to a lot of asset classes. So you can get into real estate, gold, silver, debt, equity, everything through a mutual fund. However, a lot of administrative complexities and unnecessary tax burden because you own mutual fund units and not securities. Even if you're not redeeming any mutual fund, you will have to pay taxes as per the PFIC for US tax purpose. Also, there are very few AMCs, there are very few fund houses that are accepting money from the US and Canada based NRIs. So, this is not the best choice for all of you. Is there a better choice? Yes. There's something called a portfolio management services. Works like a mutual fund, except that you don't own the units of a mutual fund or a particular fund, but what you own is securities in your name, which makes the whole regulatory environment very easy, tax implications, etc., etc. That is all taken care of. But there's still a problem in this particular PMS or any investment in India. And when I was showing you the India returns, I kept saying that these are local currency returns, and the depreciation, the INR USD relationship is not taken care of. There is an option, which is the latest option, which is the Gift City products, which are basically you can invest in India, just like mutual funds or a PMS. There's a fund manager, there's a theme, you know what you're investing into, but all that money is dollar denominated. There is no TDS. You can remit funds directly into the funds. You don't even need the NRO NRE account. So this is a fantastic option currently. The minimum investment amount for this is $150,000, but I think it takes care of all the diversification that you need if you want to invest in India without any hassle, without currency risk. Some of them, because Karthik did mention, we usually avoid taking names or making recommendations in a webinar like this. But he did mention that give them actionables and give them the, thoda sa products bhi bata dena. So some of the products are on your screen. These are good funds. Again, different mandates, different fund managers, but dollar denominated, no TDS, all aggressive, all investing in the India story. Even if you are coming back to India in the next 3, 5, 7 years, these are fantastic funds to get the India exposure. And I can skip all this. I can skip all this actually. Just a small thing. We are Scripbox. We manage 21,000 crores of assets of investors' wealth across India, over 1 lakh families, about 2,500 crores in portfolio management services, growing with our clients' trust. We have beaten the market 9 out of the last 13 years. And yes, that's about it. We can start the questions.
Wonderful. Thank you, Ritika, for speeding through that. I know you had.
I hope I was not too quick, but I
No,
had to
no.
finish it on time.
It was really good and a lot of clarity in what you were mentioning. Obviously, the questions are many. Most of them are
Hmm.
real world scenarios from
Hmm.
small to big questions. I hope you can see the chat box with all of them on your side. Can you just double check that? Because it was meant.
Yeah, now I can. Yeah.
Okay. So do you want to like go
Hmm.
through each of them in that order? Um,
Okay.
that's
Let's
the
just
easiest
let
way to
me.
go through them.
Mm-hmm.
And there are some very
Can
basic
you
questions.
see the screen? Can you see my screen? Do you see the chat box on my screen right now? No.
No, we can see the QR code while slideshow.
Okay, okay. Just give me a second because Ravi also is there to help me. Both of us will take the questions. I'm just
Sure. Mostly,
going.
I am able to see, Ritika, the
Okay,
questions are related to the taxes or residential
okay,
status. So what
okay.
I'll do, I'll quickly
Hmm.
go through one by one,
ठीक है.
as fast as I can. So the first one
Okay.
Yeah,
is the,
Ravi, there is
yeah,
just there's few questions in the Q&A box as well.
right,
So
right. I'm referring to that only, but there is a lot actually.
so
So
maybe
I'll
both
go.
you can like
Yeah,
uh,
I'm going one by one. So from the beginning,
Hmm.
I'll see
Hmm.
how much we can cover in this call. So is there any limit on how much USD I can move to FCNR account? So there is no limit. You can transfer how much you want to under FCNR account. There is no limit at all. Second question, 182 days starting from April 1 to 31st March. Ritika answered it is April to
Hmm.
March, what we follow in India, unlike US, which is Jan to December.
December. Hmm.
Yeah. If you later return to US, funds lying in RFC account can be freely remitted abroad in full without any LRS limits. So
Hmm.
one had
Hmm.
asked the question that, once I became a resident of India, what I can do with the FCNR account if I transfer it to RFC and again go back to US, whether I'll
Hmm.
be able to transfer it or not. Yes, you can transfer it without going through the LRS limits. Then moved in India 2024 after 11 years in US. Closed my NRI NRO account since I'm no longer an NRI. When using XC ICICI money or other USD INR conversion services, is it okay to get the corresponding INR proceeding directly into my standard saving Indian saving account? Yes, it is perfectly normal. Under FEMA law, you can receive your money directly into your saving bank account. Next question,
Ravi,
if you,
एक question. I
yeah.
think एक question छूट गया बीच में. Is it recommended to start the mutual fund investments in India? While in USA, at least 2-3 years before returning, will this be a headache because of PFIC rule in USA? Yes, it will be a headache. Mutual funds, you will not get a lot of options to invest in mutual funds if you are a US NRI, and it will definitely cause you administrative issues. The better option for you to start investing in India, as we discussed, is either a portfolio management service or now the latest one, which is the Gift City funds, which will give you the India exposure without any other hassle.
Right. And for US people, Indian PMS, which the underlying holding is equity shares, are much more beneficial than a mutual fund because it skips the PFIC taxation rules in US.
Mm.
Okay. If I choose to keep my stocks in US and not sell them post losing my NRI status and gift my child who is a US citizen, will there be any taxation around that? So in India, I'll talk, there is no
Mm.
taxability for any of you, why, both donor and donee, but in US,
US, there is. Mm.
since the donor is a non-resident alien, but the donee, he's a US citizen, even being a child, right? So you have to go through the gift tax rules, which says that approximately 18,000 USD, which was the rate of 2024. I need to check for 25. So
It's
you can,
$15 million now,
no, for
2020.
non-resident alien, that
Okay.
50,000,
Okay.
that
Okay.
14-15 million limit is not applicable because the donor is
Okay.
a,
Okay. Sorry.
in US, donor
It,
are liable to pay
mm.
gift tax, unlike in India, right? So they get a 18,000 exclusion per donee, and
Mm.
if it is crossing that, then they have to go through the gift tax rules, and they have to file Form 709. Next is, if I have funds in the US stock 401k,
Awesome.
are there any risks that I need to keep in mind when it comes to getting access to the funds? So there are, technically, I'll say, the compliance or the friction in dealing with the accounts once you are back to India. So broker may freeze the account if you do not have the foreign address still available. They can ask you to file form W8 Ben and all, proof of non-US residency. So they may create, it depends again on broker to broker. So you may have some friction if you keep it there. Then US also withholds 25% tax under DTAA, and you can means all of you must be aware that you can withdraw it without penalty after 59 and a half years. An early withdrawal will attract 10% penalty. Next, can we set up will and
Mm.
estate planning for US assets even after moving to India? Yes, of course. Not no bar on that. You can do that. You can cover your uh, foreign assets through a Indian will also, not a problem. We lived in US for 16 years and now moving back to India in next few months. I was primarily earner and my wife worked part-time on and off. We always filed married filing jointly. We have all our money in my brokerage account and we will be getting home equity when we sell our house this month. We both are home title. How can we split the money in USA so that once we are in India and move funds in India, we can get the tax advantage of investment on two PANs card in India without any issue with income tax rules? So you are asking this question at very right time, because once you are back in India and then you give it to your spouse, clubbing provisions will apply, and that any income from that gift will still be considered under your tax income tax under your income in Indian income tax return. So what you can do is, first, normally, since both of you are having the title in the property, Generally people take it 50-50 legal ownership. So while being in US itself, better to split that money into two parts, and ma'am can receive the remaining 50% or whatever ratio you decide in between, as per the agreement you are entering with the buyer. Is it 60-40 or 50-50? You split that money, and and ma'am's share she will receive. So once that money you repatriate to India, there is no question of clubbing, and in the even the Indian authorities will not have that information because you are still a NRI. So that you'll be free from that clubbing angle, and you can enjoy the two pan thing. And one can look at HUF, creating an HUF planning also and all. That is something you can look at. Then what about the brokerage account? Then you can I'm not sure you have not mentioned about your green card status or anything. You just mentioned 16 years. I believe that you can gift it to your spouse, and if I believe that you have that green card and long term resident status. So spousal transfer, you can transfer it to ma'am, and there will be no capital gain on transfer, and she can invest once she is back to India. Can we keep NRE NRO account during RNOR status? So as Ritika said, there are two type of we have to look at residential status from two point of view. One is under FEMA law, another is Income Tax Act. The residential status under Income Tax Act determines whether your certain income will be taxable in India or not. But FEMA law is something different. It says that where it applies, whether you are resident or not under FEMA law, accordingly you can keep NRE account, or you have to convert into a resident account. Uh, Again, in both the laws, even 182 days are common, but one thing is different. In FEMA law, intention is seen. Whether your intention is to live in India or outside India, one person can have 10 times residential status change in a single financial year under FEMA law, because they keep going outside India for employment purpose, or they're coming back to India under employment purpose. This is theoretical, of course, but as per law, it is possible under FEMA. So if you have become a non-resident under FEMA, resident under FEMA law, then you have to compulsorily convert back into a resident account. In case you are still a non-resident under FEMA, because you're even you got caught under the income tax provisions of residential status, and you are carrying a R0 status, but you are going outside India for some other purpose, which makes you a non-resident under FEMA, you can keep that NRO account. So both residential under status under FEMA law and Income Tax Act works differently. They looks at different things, and both this is possible. But yeah, you have to look at whether you are a non-resident under FEMA law or not to keep that NRE NRO account. What pros and cons should I weigh to determine whether I should leave my 401k in US and withdraw with penalties? So basically, it depends. It's a long question. It can't be answered in detail on this platform, but the dynamics, how means how what Ritika was also explaining, that India is a growing market. We are the fastest growing economy in the world. We normally means Indian platforms, Indian investments are making around 15-16% also, rather than US, which is 7% nominal. So even if you pay say 10% on withdrawal, I assume that you are not 59 and a half, you pay 10% penalty, and you pay if you are in 2024 tax bracket in US, you pay that tax. Still the compounding, if you carry that in US for coming few years, the growth rate is low and the tax rate is high compared to India. So ultimately, if we look at Indian market, which makes 15-16%, the tax rate on the long term gains are 12.5%. So the CAGR, the gains compounding effect you will make even after the taxes, upfront taxes paid in US, is much more better than what you would have made in US. So it is subjective. It needs detailed, means a look by the advisor. But
I would,
I'm a
yeah,
face,
I would,
yeah, yeah,
I would
yeah,
say,
Ritika.
Ravi, sorry, I would say that growth rate will not be a problem. Clearly, India will give you very good compounding over the next few years. Anybody in India who wants to take US exposure usually does so because eventually they are planning for their children to go outside, and they want, they don't want INR depreciation against the US. But now there are a lot of options where we from India can invest and take exposure in the outside markets as well. And the administration and the operation bit of it, who knows what laws will change eventually in some the years down the line. Something happens to you, who will go? And so there are a lot of administration and operations things that you must consider. Growth will
Right.
be taken care of in this country also very well. Um, and even if we were to take that hedge, the USD INR thing, that also option is available now. So it's a personal choice, but purely from our operations bit, that's a big thing you should consider. Also, before we jump on to the next question, just want to request all of you, if there are a lot of questions, we will try and take all of them here, but you can scan the QR code and book a one-on-one consultation with Ravi, with me, with all of us. Because there are a lot of nuisances which could be different for different people, and it is better to have a one-on-one. Now we can continue, Ravi. Should I say the next few questions if you want to take
Uh,
a break?
no, I'll
अच्छा,
continue with
okay,
few more.
okay, okay,
Yeah,
बोलो. हाँ
no
जी, हाँ
worries.
जी.
So next one, US source income not taxable in India
हाँ.
during honor status, but taxable in US. So it depends whether you are a US citizen or not, because a US citizen, even being a resident of India, they are liable to pay tax in both the countries. US citizens are liable to pay tax on global income, even if they are non-resident in that period. And in India, you will be taxed because you are a resident by number of days you stay in India. So yes, being a earner, you may be liable to pay tax in US in case you are a US citizen. Regarding the 15 lakh income requirement, does this apply to if we are married and filing jointly as well? So there is no concept of MFJ filing in India. Everyone files tax return individually. So that 15 lakh limit is per person per individual. Yeah. What things we need to take care during Arnor status? There are many, Ritika has highlighted, but the major two, if I say that people miss, is foreign asset disclosure. They think that they are still not getting taxed on their foreign income, so they are not liable to disclose their foreign assets. But since they are a resident, so they are supposed to disclose their foreign assets while filing Indian income tax return. In case you fail, of course, that Black Money Act and many things come into picture, so better to disclose it upfront. And the second one is it's a very great
There
period
is.
to plan
Sorry.
your exits from foreign assets to avoid double taxation, because you are still not taxed on your foreign income being a earner in India. Does the NRI definition apply to an OCI card holder as well as, are there the rules same as far as taxation is concerned? So OCI is nothing, it's just a proof that you are of Indian origin, right? There is one more definition of PIO, person of Indian origin. So whoever was born in undivided India in Bangladesh or Pakistan, there is still a PIO. And then government tried to sideline the PIO definition, and they came up with OCI card. So even if you are having a OCI card, it doesn't make you a resident of India by default. You have to comply with the 182 days, 60 plus 365, those rules regarding the stay. Okay. Okay, done. Question on RSU, ESPP are granted while the individual was in the US, but sells them. Sorry. So questions on RSU, ESPP. Yeah, RSU granted while individual was in US, but sells them in R not status as qualifying disposition. Will these be taxed as ECI, effective connected income, for the tax purpose in US and non-resident? So uh, for people who has earned those RSU ESPP while being on payroll of a US employer, so these are connected to the income, US source income, and US still may tax it. Unlike the ESOP, Indian employee earns from, of course, a US company, but they are employed in India. So those are exempt in India, but since you are under US employment and you got that ESOP, ESPP, it is considered under effective connected income. Hi, we are planning to move to India in June 2026. Should we open a will here in US before we answered almost similar question. You can make a will while being in India also. It's not hard and fast that you make will when you are in US itself. How many years of R0 status we will be in if we return to India in say mid-March? The similar scenario is covered in our illustration, 4-page illustration. So
Mm,
depending on the scenario, you will be minimum three times you'll get a R0 status. First year maybe a non NRI status, which is better
mm.
than R0, and the next two will be ROR, R0. Of course, why 2 to 3? Because it depends how because you have to look at your past stay in India in last 7-10 years. So minimum 2 to 3 times you'll get the R0 status. What about the US citizen living in India and they are in ROR status? Do we have to pay taxes in both countries? I answered just a few minutes back. Yes, you since you are a US citizen, on global income you are supposed to pay taxes even if you are a non-resident. Means you are not living in the US, and in India because you are ROR, you have to pay taxes in both the country. Yes, double taxation avoidance agreement comes into place, and whatever taxes you have paid in US, being it being a source country, you will get a foreign tax credit of that while filing the Indian income tax return. So there is just to avoid the double taxation. So any differential higher taxes you'll be liable to pay in India. Okay. Ritika, you may
Mm.
you continue for a time, and then I'll answer.
Hey, just
Okay, so
plugging in something there. Just a
yeah.
reminder, while Ritika is choosing a question. So we have the QR code flashing on the screen, which will take you to a link that'll enable you to book a one-on-one consultation with Ritika or the Scriptbox team and or Ravi as well. So please make use of that. Also, the link is directly shared in the chat box, and also I'll be sharing it within the groups as well. So make sure you do that because many of the questions are pretty much, some of them are repetitive. So Ritika, you might want to like bundle them together and move to the bigger ones or the significant ones.
Uh,
But yeah.
Okay, okay. Okay. Is there a golden period where you are in RNOR status, so you pay the lowest tax in India and also lowest tax in the USA when you are in the lowest tax bracket? I think the entire RNOR status is a significantly transitional good period. Correct, Ravi? There's no specific period within the RNOR status that is a further a good period, right? For that,
Sorry. Can you give me the
okay. Is
timestamp? Timestamp. I'm just trying to find
is
that
there a
question.
golden period where you are in RNOR status? So you pay the lowest tax in India and also lowest tax in USA.
Uh,
9:56 p.m. Hanji. So I
Not
think the entire
yeah, no time specific as such.
hmm,
Simply are not supposed to pay tax on the foreign income. So
hmm.
that time you can exit from your foreign assets so that you pay taxes there only. And but yes, from different angle, if I say that once I'm assuming if you are not holding a green card, right, and you're not a long-term resident, just to avoid the exit tax. So once you are a Indian resident and it's not a ESOP or ESPP, it's a normal investment. So usually the gains you earn in US will not be taxed by the US government. It will be taxable in India, and the tax rate are lower in India. So you have to go carefully and look at the asset which you want to exit and the time period. So there are so many variables one has to look at. No straightforward answer.
Had a question about how taxation works post RNOR. Specifically, say I decided to sell 10,000. So I'll shorten this question. There was a slide which I skipped. This will be subject to capital gains taxation of India of equity markets. So if you're booking capital gains in equity markets and if they're long term, if your holding period is more than 1 year, then you will be taxed at 12.5% of the capital gains tax, basically the long term. If you have not completed 1 year as a holding period and you're selling something, then the capital gains tax is at 20%, which is short term. Does it make sense to invest in India with rupee going down rapidly every year? We have big chunk of 401k amount. Should we stay invested in the USA? Move the funds back to India after moving back to India and invest in India. Please note that we'll have to pay 10% penalty and tax here in USA if we decide to liquidate. So the same
I
question.
answered the same question. Yeah.
Yeah, correct. Can a Canadian citizen invest in Indian stock market? Um, I think the best route for you will be the PMSs or the new Gift City funds. So you can definitely take Indian exposure. Okay. The following scenario, how long can the NRI remain in RNOR status? Has been
Uh,
NRI, Haji.
I think it's better to avoid.
Okay,
We
it's
have
too.
discussed
Okay.
too much.
Yes. Take
Yeah.
it. Okay. Does Ritika and her firm help with taxation and investments? Yes, we do help. We at Scripbox help um, individuals with investments, financial planning, investment construction, portfolio construction, and of course, taxation would be a part of it. Thank you, Shweta. Can we get the recording? Not sure. It will say Gift City versus FCNR, which is better. So it's like Gift City, you can actually take exposure to equity products. Gift City, through Gift City funds, you can actually invest in equity funds, flexi cap funds, hybrid funds, etc., where the return will be much higher than a FCNR deposit at this point in time. So definitely, equity oriented Gift City funds would give you better growth if that is what you're looking for. Regarding moving uninvested money to India, since we have a huge sum cash in bank saving accounts with house, do we move all the amount to NRE account and put some of it in FD, or should we move it to FCNR account and open regarding moving uninvested, since we have FCNR, and open a FD there?
So first,
Again,
I'm assuming that you are moving funds from NRO to NRE. There is a limit applicable to that. I'm assuming you are an NRI. So a maximum up to 1 million one can transfer. Uh, but again, it is on specific item only. These cash item you can't move, and you have to go through the LRS limit. Form 15 CACB filing in India will be required. Moving to FCNR, I don't think you can move to FCNR. FCNR is something that you have earned abroad, and you are moving that money to your foreign currency account just to avoid any foreign exchange fluctuation.
can you elaborate a bit on Gift City based on maturity? Would like to invest in dollars there to get out of United States estate. Are you sure you need foreign asset disclosure on RNOR status? So first question I'll take, and then Ravi can answer the second one. Gift City based on maturity. There's nothing. Gift City is a way to invest into the Indian capital markets. There is no maturity as such. Because it's equity markets, there's no lock-in, there's no maturity. There could be a debt mutual fund or a certain feature attached to a particular Gift City fund. But as of now, I think they're all equity oriented and there's no maturity feature really in this.
Right.
Mm, mm.
On the second point, there has been a scenario that clients has received notices from the income tax department saying that you have not disclosed your foreign asset even in the R0 status. And I'm talking about this last year only. And in December, and many newly converted NRI to R0, they have received it. They forgot to disclose. They forgot to disclose it to their advisor also, or to their CA who are filing the tax return. So please disclose your foreign asset even being a R0, because you are primarily a resident, but not ordinary resident. So residents are supposed to disclose their foreign assets.
Is Gift City investing only for NRI? Gift City investing is actually both offshore and for all of us in India who cannot take exposure in global markets because there are some restrictions on mutual funds taking exposure to foreign markets. There are Gift City products available to us as well, where we can take exposure in the US market sitting in India. So it goes both ways. Um,
Ritika, I just
does
want
gi-
to
yeah.
to everyone listening, if you want to
Mm.
come on the mic and maybe ask a question in detail, you can raise your hand and we'll give you the opportunity as well. Because some of the questions would need additional details also being asked. So just letting that out now. Yeah. Ritika, back to you.
Sure. Um, Does Gift City investment lock in your investments? No, if there's no feature in that Gift City product. So a Gift City product could be given by any mutual fund company or any PMS provider, um, unless and until it is stated that there is any investment lock-in feature. There is no lock-in in your investment. Um, 401k and IRA and what to do with it, especially with US volatility with their governance. We have discussed this growth you will get here as well. So you can definitely get the money back to India whenever you're coming back. Um, do you help in choosing the return date for USA, which results lower tax liability overall? Also, suggestion around to keep withdraw while coming back. If I want to know, withdrawal is not taxable. All the profits they're not. If I want to invest in mutual fund investments for portfolio gift, all the profits is not taxable in India. No, if you are investing in any mutual funds and PMS or Gift City, if you have come back and you are investing, then everything is taxable in India. It will go as per the status we discussed: NRA, NRI, RNOR, or ROR. Accordingly, according to your status, the taxation will be applicable. Do you help in choosing the return date from USA? I think the case study we did. I think
Uh,
if we
So I'll
please,
answer
Ravi.
the, yeah,
Mm.
sorry. So yes, we guide our clients when to, plan their exit, how to move their assets, asset allocation, when to exit, and this is part of our services. So we guide our clients on case to case basis based on their facts. And yeah, so on 401k also based on our understanding, we guide them. Third one, mutual fund investment portfolio gift. So I'll talk about gift. Normal investments, portfolio investments, and mutual funds are usually taxable. But anything you may do through the gift city, there are special tax benefits given to NRI where the tax rates are either nil or it is reduced one, which is not normally not available to normal NRIs if they invest other than through gift city.
Ritika, Ravi, there's
Yeah.
a few questions in the question and answers box
Yes, I'll
from
go
the
to
chat.
Haji. Sure.
Just for the sake of time, I'll just pick one question. Okay.
Mm-hmm. Yeah, yeah, yeah.
Lengthy, I think it's significant.
That went, yeah.
Asking, what is the best way to transfer money from bank accounts once a decision to move back to India has been made? Transfer it all once before flying, or fly back to India and make online transfers strategically into different investment options and bring down balance to zero later? Two, that's the first question. Second question is, what are the tax implications in India of transferring a bulk amount into a saving account in India? Do we get
S-
differential rates by transferring it to NRE account and then converting it to resident account after relocating? This was asked by Indranil Shikhare.
right. So whatever amount you keep in NRE account, NRE can be kept by only a NRI, right? So NRE has a special tax exemption on the interest income. It is not taxable in India. But and what about the amount what you can transfer from outside India to India? Government is happy to take any foreign, foreign currency or the amount into India. They're happy. There is no capping on that. And if you put that in the saving bank account, so it will trigger the normal saving bank interest, which is taxable, which usually you could have saved when it is in NRE account. But yes, NRE you can enjoy only up to certain period. If you have made an FD in NRE and you are back to India. So in that period till the maturity is there, you can enjoy that benefit. But after that, you have to surrender your NRE and convert into a normal resident account.
Okay. Another question is, when returning to India, should the US bank account be open if we have a term life insurance in a US-based insurance company? And the bank account should be a joint account? That's a question.
It depends on the insurance company's regulation whether they need a US bank account compulsorily. So I'll put it on based on the term life insurance in the insurance provider what they are looking for. Yes, it is better to keep a bank account, but people struggle even to maintain a bank account once they are back and there is a long gap and they have missed their foreign bank, sorry, foreign residential address and all. So you have to look at your term policy. You can reach out to your insurance, that intermediary for that.
Okay. Another question is, Ritika, if you have any questions you want to go ahead with, please do.
Yeah, I think there are some repeat questions we've already discussed. How does the US India tax treaty influence the global income tax in year 4? It just will ensure that if you have paid tax in the you have to in the year 4, it's an ROR. All your global income is basically is taxable in India. So if you in the year 4 also paid a tax for some reason in the US, then most likely you will get a tax credit. Most likely that tax treaty will make sure. Yes, Ravi.
Right, right. Just to give a number, let's assume
Ji.
$100 is getting taxed doubly in both the countries. On $100, you paid $10 as taxes in US, and the same income is taxable in India, say at 30%. So that $10 which you have already paid in US will be available to you as a foreign tax credit while filing India tax return, and ultimately you will pay a differential of $20 only. Means of course you will convert that amount in INR while filing India return, but for years of convenience, I was talking in dollar terms. Yeah.
I'm bunching up a few questions which all relate to taxability once you become a ROR. As soon as you become a ROR, your rest of the entire income from any part of the world is taxable in India. So,
Right,
yeah, right.
right. But you'll get a foreign tax credit if you have paid any taxes outside India.
Yeah.
And also one
Hmm.
has to look at the DTAA. Let's assume if someone is living in any other country, whether it's UAE, Singapore. So there are some loopholes, I'll say, drawbacks in the DTAA. One can take a benefit of that and they can make it exempt in India. Yeah.
Ritika, just a quick question to
Yeah.
you.
Yeah.
So with Scriptbox, what is the best way to, or when is the best time to contact you? So let's say someone is in the US and thinking
Hmm.
of returning in the next 6 to 12 months. Should they be contacting you immediately or closer to their move? That is one question. And second is, out of all these things that we talked about, taxation, status changes, double taxation, and all these different things, or maybe even money transfer as well. What are the things that Scriptbox can help them, and what are the things that Scriptbox doesn't? Just for clarity's sake.
Sure. So, your first question, if anybody is planning to make a move in the next 6 to 8 to 12 months, I think the sooner you get in touch with us, there'll be more clarity in your decisions. So there's no earliest, the sooner you get in touch with us, even if you are planning to come later, it's always nice to get the right people to advise you. That's one. And number two, we help in, of course, the financial planning. We help in the taxation bit, and we also help in ultimately making those investment portfolios for you in India. And now with the world opening up, we also have a bunch of other investment ideas that, like I discussed, the gift city, inbound, outbound, so many other things. We help in all making investment portfolios and managing them for you in India.
So it's more like a single window solution to all of these,
Yes.
like a platter of products.
Right, right. We have a extensive research team. We have tax experts. We have a whole bunch of team with different expertise to help a client with a lot of
Are there
areas.
any restrictions on the countries that you serve, or is it predominantly US, UK, UAE, and any such preferences in terms of the type of NRIs that you deal with?
No, no.
Okay, that's good to know. Cool. We have a few more questions there if you want to jump onto those.
Yeah.
3 minutes, a little overshort by the time.
The
If
mutual
I
fund,
have enough
yeah.
time, I'm good for it.
The mutual fund restrictions that you mentioned are for units purchased in the units. No issue if bought in India by an Indian citizen, regardless of residency status. Am I wrong? Not sure if I understand this correctly, but if I'm a Indian resident, then there is no issue. I buy a mutual fund, I redeem the mutual fund, I pay a capital gains tax, and that's about it when I'm a resident. Um, but if I am in the USA, if I'm an NRI from Canada or USA, because the taxation is different, the administrative part is different. Even if you are not redeeming any mutual fund units from here, you will be liable to pay a tax in your home country. So I hope I'm clarifying the question to you. If there are a lot of questions, guys, I request all of you to please scan the QR code and like book some time for us. Send us requests here, and we will do a one-on-one with all of you.
Ritika, can I pick up
Anji.
the question?
Sure, please.
So much often repeated one within the,
Hmm, hmm,
so I'm sure there'll be others
hmm,
who might
hmm,
find it useful even outside of this webinar. And this is regarding the 401k withdrawal.
hmm.
Uh, Suppose someone is in the early 40s and has about maybe let's say $150,000 in 401k and is planning to move, let's say in the next 6 to 12 months. Should they withdraw it? And if yes, what is the right way to do it? And what is the best way to bring it to India, dealing with taxes? And what is your recommended way of dealing with 401k essentially?
I think you have that entire time before you eventually will become an ROR. I'm to go back to that because that's the whole piece of strings of peace, which is very important. Before you become a ROR in India, you should get back if you want to get back, whatever you want to get back, because in the RNOR status, you are not paying any tax global income in India. And Bahar ka tax is anyway going as is, the way it is supposed to happen. But if you cross the ROR status, then you have to pay tax here, wahan pe bhi tax katega, then you'll file a tax credit, etc., etc. So I think a better way to you have that 2 year window before you become a ROR. Tab tak you guys have time to get that back to get out of it.
Got it. Got it.
And also the compliance things becomes difficult because they have to report income of and disclosure of both the countries, even in India. I assume in case the case is simple that they have just left that 401k in US and amount is not so huge, uh, considering the things we discussed like growth rate and the other things. To for their peace of mind also, they can take that money out and repatriate it to India and invest here peacefully. They can keep a habit of long-term investing and all. They can make a better money than keeping it in US and thinking about how to withdraw it, and it becomes more challenging down the line. We don't know what will happen after 10 years.
Thanks, Ravi. Um, Both of you, just a common
Yeah.
question. I know you touched upon this briefly during the webinar in your presentation, as well as when answering some questions as well. But just because this is kind of like, for the lack of words, hot topic or trending topic, gift city, right? A lot of people have a lot of misconceptions. What is the minimum? What is this product really? What are your advantages doing it? And then, of course, you answered the gift city versus FCNR well, a question as well, but a
Mm,
lot of other
mm.
questions like Gift City versus something else, another product. Why should they actually go for Gift City? Why is this suddenly the hot
Yeah.
thing, right?
I
Can you
think
just
the
give us
biggest, yeah,
your
sure,
thoughts?
sure. It's actually a great, it's a relatively new uh, product that has come up. It primarily takes away the currency risk for any investor. So if suppose somebody is investing his dollars in let's say you're not coming back to India, you are continuing to stay where you are, but you want to take India exposure, you want to invest in India as a growth market, you want to invest in India equity markets, the you will get fantastic growth at a gross level, but you will lose out on the currency because in the last 10-15 years, INR is depreciating against the USD by almost 3 to 4% every year, right? So we don't want to we keep losing on the INR. To remove that impact of the currency, people can invest in dollars and take money back in dollars. There's no conversion happening. Hence, gift cities are so hot because it gives you India exposure, no currency risk, no NRE, no NRO, no TDS deducted while you're taking money back. It's as good as you're investing in your in your home market. You send the money, invest, you redeem the money, it comes back to your account. Everything in dollar terms. It could be in Canadian dollars or US dollars or anybody outside India who wants to invest in India in their home currency. That is why the gift city, I think that is where the biggest advantage is. No operational hassles, no currency risk, no administrative issues, no taxation. Of course, the taxation rahega, but additional extra, no taxation.
Got it. Got it. Thank you. Thank you, Ritika. Hey, some folks in the chat are asking, what is your fee structure? Mallikarjun Patel was asking. And is there any fee for the one-on-one session?
There is no fee for the one-on-one session for the audience of this webinar, the Back to India community. One, two, otherwise, there are multiple ways we work with our clients. Sometimes it is fee-based, sometimes it is included in the part of the money that we manage for you. We can explain that in detail. If you are interested, please scan the QR code and we'll speak and we can explain the entire thing to you. If you want to, so one is the fee-based, one is a non-fee-based. We end up earning, if that is the question, about 75 to 80 bips of the portfolio size that we are managing.
Wonderful. That's good to know.
Yeah.
Great. So we are pretty much 30 minutes. We are overshot by 30 minutes. But a lot of questions are keeping on coming.
Still pending. Yes.
Yeah, I think it's maybe we should wrap it up. Do you want to take maybe another 2 questions quickly, Ritika? And then I wrap it up. Feel free to. You have a lot of.
Why don't you pick up 1 or 2 questions that you feel are most relevant for everybody?
Okay, so I don't know if it's
Ravi and I will be ready.
What are the things we need to take care during our own RNOR status, which is beneficial as NRI? It's a little vague, but do you have any particular answer to that, or I can take another question? Not.
No, I'll give it a shot, and then Ravi will, of course, he's the top boss in taxes and taxation.
I think a lot of people are asking for Ravi's
consultation. Yeah, so I think the disclosure on foreign assets will be the most critical part. You shouldn't be missing out on that once you are in that status. Ravi, you can add to it, please.
Okay, I'm just repeating the question.
Ji.
If my understanding is correct,
Ji.
They're asking if one is having R0 status, whether the foreign asset disclosure is compulsory, right? Is it correct?
No, the question came as what is the most important thing or the most critical things when we are in the RNOR status. So it was pretty open-ended.
Yeah, I already answered that.
Okay.
So in my view, people usually miss the foreign asset disclosure. And just a sec. Yeah, pretty much that only. So keep your and plan your exits. Those 2 were my saying. So plan your exits from the foreign assets so that income is not doubly taxed, and disclose your foreign asset. There is no downside actually. It is not like US, they tax your notional income and all. So there is no harm in disclosing it, but downside is high because the Black Money Act will apply and the penalty is 10 lakh and more.
Great. Cool. I'll take one final question, Ritika.
There is one more question from Sashidhar. As an Indian resident, can I invest in gift cities in USD? No, we have to. There is a LRS. If you're sending money outside, investing globally, then the whole LRS limitations will kick in.
Yes, under LRS, one can
Yeah.
remit, but they will not enjoy the tax benefit what
Hmm.
which a NRI can use. So the benefit of gift city is mainly planned for NRI and means NRI OCI card holders
Hmm.
by the
Hmm.
Indian government.
Yes. Okay. Do you want to answer this question from Visu? He's asking, I own rental properties in the United States. While filing US taxes, we claim depreciation and other allowable deductions on the rental income. Once I become an Indian resident, how will this US rental income be treated for Indian tax purposes? My
Right.
understanding is that India does not allow depreciation on foreign rental properties and instead follows a different deduction.
Correct. Correct. So India considered a different method. Instead of going one by one item, you can claim this repair cost or that depreciation. India straightforward gives 30% standard deduction. So if your rent is 100, government will give you 30% standard deduction, and they will allow you a municipal taxes like if you have paid any local taxes which related to property, they will allow you deduction for that. So 100 minus 30% standard deduction minus municipal taxes, that will become your taxable income, rental income in India.
Wonderful. Cool. Thanks, Ravi. I think I think we should wrap up. It's been almost 30 minutes extra. So if you agree, we can wrap it up now. Ritika, what do you think?
Yes, for
Okay. I don't want to push you too far as well. So yeah, thanks a lot,
hmm.
Ritika and Ravi. Just a quick word to all the attendees. The consultation that we have with Scripbox is completely free, the one-on-one. It's exclusive to Back to India community. So feel free to scan that QR code, and you'll be able to schedule one-on-ones with Ravi and Ritika. I'm not entirely sure if you'll be able to choose the person, but try your luck maybe. So that's one thing. The other thing is, like Ritika mentioned, Scriptbox is a wonderful company where they're serving a lot of clients like us, and NRIs can actually make use of them. They're very well, they're basically experts at this whole thing. And I've been personally talking to them before as well, and I've been very pleasantly surprised with the kind of knowledge that they could share with us. And most of them corresponds to the questions being asked in the community as well. So we will be sharing this recording on our YouTube channel, I'm hoping pretty soon. So there too, you'd be able to scan the QR code and get a one-on-one consultation. And is there anything else like contacts or anything that Ritika you want to share other than the QR code? If yes, feel free to share now. I think there is not. I think we've discussed this before, but
Yeah.
if there is, feel free to share. Um, but yeah, thanks a lot, everyone, for joining. This has been hugely valuable. I've been getting a lot of questions from the group, a lot of appreciation already coming in, and a lot of requests for sharing the slides and the presentation offline. So we'll be doing that on YouTube, like I mentioned. Ritika, Ravi, any parting words before we wrap up?
Thank
Yeah.
you
Oh,
very much. Yeah.
so,
Thank
sorry.
you
One more thing.
for making.
There is a Sorry, Ritika. Sorry. There is a poll that you'll be
Yes.
getting soon
Hmm.
after this webinar. If you can please, you know, vote for very useful, average, or not very useful, whatever is your honest feedback, please do that. That'll be hugely beneficial for the Scriptbox team. So, sorry, Ritika, please go ahead.
No, no, absolutely. Please give us the feedback. It will help us be better the next time. And we'll hopefully answer more of your questions and have a longer this thing the next time we come. If you want us to come next time. So please do give us your feedback. It will be very, very useful for us. I hope all of you enjoyed. Thank you so much for making us a part. Thank you, Ravi, um, for being there. And yes, please get in touch with us. And all the questions that we couldn't take, we would love to take them up separately.
Wonderful. Thanks, Ritika. Thanks, Ravi. Thanks, Prashant. This was wonderful. We'll be sharing all the details in our groups on the Facebook group as well as the individual WhatsApp groups. So feel free to follow the instructions shared there. I hope this was useful. I hope we'll do more sessions in the coming days or weeks. So thanks again, all of you, for joining. Have a good night.
Thank you. Thank you. Bye.
You.